I know there are a lot of people, actually probably most of the people watching this course, who don't want to become accountants. If you wanted to become an accountant, you probably would be doing something else right now. And I also make a promise to people when I try to convince them to use accounting software that you won't have to become an accounting professional. What I need you to know, though, is that it is important to understand some basic accounting concepts. While it's true that you don't have to know these, I think it really helps you understand what the software is doing and why you need to do the things that you need to do in the way that you need to do them. In this chapter, I'd like to introduce you to just some of those basic accounting concepts that will help you understand and have an edge using Peachtree. I think in some ways accounting actually gets kind of a bad reputation. You know, in some ways it's very, very basic. Money comes in and money goes out, and you simply need to track it. Now, anybody who's ever taken an accounting class for, 18 weeks or so, or maybe even a couple of years, will say, yes, there's much more to it than that. But we're going to try to use the KISS principle here, and that stands for Keep It Simple, Sweetie. So let's get into just a little bit of what some of the terminology is that you'll hear about accounting. First of all, you may hear the word GAAP, which is called Generally Accepted Accounting Principles. Now, this is stuff that just kind of floats around in the universe that people who work with accounting know, and they really are the principles that don't change. They've been defined by industry professionals like accountants and legal people, even tax advisors. And when we have laws that change, and actually they change even year to year or quarter to quarter, that's okay, but the accounting principles do not change. And this really is the underlying foundation of all good bookkeeping and all strong accounting. When we talk about GAAP, one of the primary things that we'll hear is called double entry bookkeeping. This was actually started, some say, by the Venetians, who had a great banking system. But what it means is that every transaction actually is going to have two entries. If you're going to take something from one account, you need to balance it out with another account. It's kind of like having matter in the world, if you've ever taken chemistry. The matter doesn't change, it just goes from place to place. It's the same thing with money. Money actually doesn't go away, we just transfer it from account to account. So your accounts always must remain balanced, and Peachtree is going to help you do that. This double entry bookkeeping is happening mostly in the background, unless you happen to be working specifically with a general ledger entry. All of the accounts that you work with are going to be held in the chart of accounts, and we'll take a look at that a lot in one of the later chapters. But basically, this is just a structured list of all the accounts and all the things that you're going to use to show in your financial statements. These will look very familiar to you. You will have expense accounts, liability accounts, and income accounts. It can be very simple, or it too can be very complicated, depending on the details that you want to have in your accounting. When we talk about those different types of accounts, there are actually two kinds of account balances. Now, I don't want you to worry about this too much because, again, Peachtree is going to take care of this in the background. But we have temporary account balances and permanent account balances. Temporary balances get reset each period, like when you close out a month or a quarter or a fiscal year. And these appear on the P&L, or the profit and loss statement. An example of this type of account is the cost of goods sold, or the COGS account. On the other side, we have permanent accounts, and these accumulate over the life of the company. They never go away, they never get zeroed out, they're cumulative, and these are going to show up on the balance sheet. This would be something like shareholder equity, the amount of equity that the shareholders or the owners have put into the company over time since its inception. Now, all of these accounts on the chart of accounts are actually created in one of three ways. We can create them as part of the new company setup wizard or the company file setup. Hopefully you'll be using the wizard and not doing that by hand, because by hand is the hard way. We also can set them up within the company file, and some of them are actually created automatically as we create different types of transactions. In general, then, we have different categories of accounts. Expenses, income. Income can be cost of goods sold, and one of the equations you'll often want to know is income minus the cost of goods sold equals your gross profit. So if I sell something for $100, but it costs me $25 to produce it, then my gross profit's going to be $75. That's where this equation comes into play, and of course that really is the important number, because we can sell things for any amount we want, but if we're not making a profit on it, it doesn't really do us any good. In addition to expense and income accounts, we also have asset accounts. Hopefully your company has some. Current assets like cash, accounts receivable, and inventory are things that you expect to turn over within about 12 months. Fixed assets, on the other hand, are going to be longer than that. Equipment that you buy, furniture that you own, or vehicles that you purchase. Those are all examples of fixed assets. Then, of course, we have liabilities. I wish we didn't, but every company has some. For example, you may have rent that you need to pay. And then there's an account called equity and retained earnings, which gets a little bit further than we want to discuss right now. So these are our general types of accounts that we can have within Peachtree. Then we can get very specific, and I don't want you to memorize this list, but these are just some examples of the types of accounts that you can have within the categories that we just discussed. Again, you should see some that are familiar to you and some that may not be. Accounts payable and accounts receivable, cash, and cost of sales, those are all things that we're going to see that we know. Maybe some of the others you'll need to use, but we'll get a little bit of help with those when the time comes. Okay, now I want everybody to bear with me for just a few minutes so we can discuss the accounting equation. It sounds technical, and in some ways it is, but it's also the absolute foundation for what Peachtree does, so I won't ask you to necessarily be able to apply it to a specific situation, but you need to know it's working in the background, behind the scenes. All right, here we go. We'll take it kind of slow. First of all, resources controlled by a business are the business's assets. New businesses really only have two sources of assets. They have investors who provide capital, and that could be owners or shareholders, or they have creditors who provide credit, such as a bank loan or a line of credit. The total assets of a business, then, are equal to the sum of the assets provided by the owners plus the assets provided by creditors, also called liabilities. Everything else we track will fall into this equation one way or the other. All of those other things really fall under the owner's equity portion and are tracked by temporary accounts until the end of the accounting period. And what I want to do is actually take a very specific look at how you might be able to apply this particular equation. Remember that we're going to take a look at it the hard way, but then we're going to let Peachtree do the work, but this is what it will be doing every time we click Save and Close on a new transaction. So here's my real-world example. We have assets equal liabilities plus owner equity. That's our equation. And here are the things that have been going on in the first few days of our business. We had an owner who contributed $10,000. We made a purchase of inventory that was $2,000, but we didn't pay any of that up front. We're on a net 30 term for that. We paid for some rent that was $700, and we actually were lucky enough to actually sell $1,200 in product, but we only collected $500 of that $1,200. That means the rest of it is still in receivables. The inventory that we used in order to create that $1,200 worth of product that we sold was worth $250. And then we did make a payment finally towards our inventory balance of $400. So far so good? Not too bad? All right. This next slide is going to get a little bit tricky, but we'll take it slow. The first part of the equation is actually fairly simple. Assets, liabilities, and owner's equity. Here's how it all starts to fit in. First of all, we had the owners who made a $10,000 contribution. So remember, we need to balance this out, and we're going to add $10,000 to each side of the equation. So right now, 10,000 equals 10,000. That sounds like a great deal. It's entered as a positive cash asset on the left and company capital on the right. Next, we have inventory that was purchased. Now what we're going to do is we're going to add a positive $2,000 on the left, and this is going to be an inventory value, and a positive $2,000 on the right under accounts payable because we didn't pay for any of it up front. So all of that's on net 30, and it all has to go in on the right in a single entry. The next item that we had is rent that we paid. It's going to take $700 off of the left because a payment reduces our cash, and a negative $700 on the right because it's an expense. Then we were lucky enough to sell some product. Now this one gets a little bit trickier because we have to split it up. Our sales total is split because we did not receive full payment. So we add $500 in our cash reserve, that's how much we were paid, but we also have to add $700 in our accounts receivable account. On the right-hand side, the full value of $1,200 is entered under income. Unless you're completely a service company, you're going to have some type of inventory that was used as part of the sale, and this is no exception to that. So we have to account for the inventory that was used as part of the sale, and this is subtracted from our inventory account on the left and also from our revenue and expenses on the right because the net of the sale has to take out the cost of producing the goods that we sold. Remember that good old COGS thing. What did we actually make? Well, we have to actually say that we didn't make all of the money that we sold. Part of that was into our inventory that was required to create it. Then we went ahead and, good news, made a little bit of a payment on our inventory bill. For that one, we paid part of the inventory to our vendor, so we subtracted that payment of $400 from our cash account on the left. Anytime we're writing a check, that's coming out of cash. And likewise, we also were able to subtract $400 from our accounts payable on the right. As we pay that balance down, it does reduce our cash, but it also reduces our liabilities. Here's the good news. Remember when we said everything has to balance? Well, at the end, the company books are in balance using the accounting equation because 11,850 equals 11,850. Now, this is a specific example of how just a few different transactions go into the equation. I think you can see that when you break it down, it's not really that confusing, but fortunately, Peachtree is going to take the possibly hundreds or thousands of transactions that we do in a day, a week, or a month, and it's going to be doing all of this math behind the scenes. Now that we can take a little bit of a breath because we're not going to do any more math, we can talk about accounting methods. When you set up your company file, you need to decide what type of accounting method you're using. Actually, you probably already should have known this, whether you were using software before or not, because this is something you have to report on your taxes when you first file a tax return. We have two choices here. We have cash and accrual. Cash is where income is credited only when the money is received and expenses are counted only when the bill is paid. So if I sell something to you today for $100, I don't get to count that until you pay me. And if you don't pay me in 30 days, then I don't get to count it until next month. Companies with less than $5 million per year can usually choose either one of these methods. Now, don't quote me on that because that's one of those things that changes all the time. But as of this moment, I believe that's the general rule. And if you hold inventory that you resell to the public, the IRS actually requires that you use the accrual method, which is the other method. Now, speaking of accrual, that's over on the right-hand side. Accrual is income credited as soon as a transaction occurs, regardless of when it's paid by a customer. And expenses are counted as soon as a bill is incurred, regardless of when it is due. And this is when people try to start playing both sides of the coin. If you want to make your financials look good, you would want to count every bit of income that you've invoiced for, whether you've received it or not. But you wouldn't want to count your expenses until they're actually paid. Unfortunately, you can't do that. You have to pick one or the other. Usually, accrual is going to be entered on job completion. This is a very easy thing to understand and something that's important that you choose. Most companies, I think, are actually going to be using accrual. It's really a more accurate way to look at your money, but some people do use cash. Usually sole proprietors are very simple businesses. If you have any questions about any of this, that's when you should be speaking to an accountant.